Welcome, everyone. My name is Johanna Siljakus. I work as a consultant with the ADB's Transport Sector Office. And I want to extend a big thank you for joining us today and welcome to this online training workshop exploring financing strategies that would make e-mobility projects viable. So if we can have the next slide, please. So in today's workshop, you will be hearing about a number of different financial instruments that enable e-mobility project financing, as well as exploring different types of risks involved, mitigation of these, and insights from successful e-mobility financing projects or models. The session is actually targeting Southeast Asian audiences in particular. However, the learnings that we'll gain from this session will be surely interesting throughout Asia and the Pacific. So we welcome everyone or anyone from any region to join this session. The workshop is arranged under the umbrella of the e-mobility support and investment platform for Asia and the Pacific. This is a knowledge sharing platform which aims to build capacity and support the scale up of e-mobility in the region. This platform is led by the Asian Development Bank, and it forms part of this global initiative supported by the Global Environment Facility, the GEF, as well as UNEP as part of the Global Electric Mobility Program. We also have other supporting partners, including Green Climate Fund, Republic of Korea, E-Asia Knowledge Partnerships Fund, and Japan's High Level Technology Fund. And for your information, this session will be recorded and it will be also posted online, so you can watch it afterwards. And if we can have the next slide, please. So before getting started with the workshop, a couple of words from the e-mobility platform side. So first, we'd like to mention that we are actually officially launching the website of the support and investment platform for Asia and the Pacific. So it's now live. You can access this through this email address on the screen, so e-mobilityplatform.asia, or there's also a QR code. The website includes upcoming events, knowledge products, all webinar recordings from the past, e-mobility country profiles produced by the Asian Transport Observatory, newsletters, news, etc. And do let us know if you wish to collaborate with us, for example, writing a blog post for our website. Do get in touch with us. We're very happy to discuss potential collaboration on that side. And then I'd also like to share with you that we will have 2 more online training workshops coming up next week. Also looking at different aspects on e-mobility scale up. So we have a first topic on e-mobility roadmap development, which is delivered by Rahul Bagdia from P Manifold. It looks in particularly at the gap we have identified in Central and West Asia on the need for strategic roadmaps, but it's again open to everyone and probably relevant for many countries in the region. And we will be looking at e-vessel, the future of electric light vessels. This will be held in collaboration with GIZ and the University of Applied Sciences Emden-Lehr from Germany. And it has a focus on the Pacific Island countries, but surely also interesting for many other audiences. So welcome, you're very much welcome to join both these workshops. You can find the registration links in these QR codes. We'll also post them in the chat a bit later on. Okay, and if we can have the next slide, thank you. So let me now hand over to Bert Fabian. He's Senior Transport Specialist at the Asian Development Bank for some welcoming remarks from ADB's side. Thank you.
Thank you very much, Johanna. Not really welcome remarks, but I would just like to take this opportunity also to thank our main partners for the support and investment platform on e-mobility for Asia Pacific. Of course, our trainer, Koen our partners at ITP, who has really helped pull together all these trainings and webinars over the last few years. Of course, Johanna as well. And now we are at the stage of having this series of training workshops on various topics that have been identified as key interest in Asia Pacific, and one of them is always financing. We are lucky to have Koen from the Rebel Group, who has been working with the Asian Development Bank on these issues. We will be focusing on projects. I realize there are several ways in which e-mobility projects and policies can be financed at the national and city level. It's good that we have some representatives from cities as well here, and in case you would like to know more about these projects, cases that Cohen will be providing some examples to, you can contact us to provide more information. And if you want to pursue this further, ADB has supported several projects together with national government, but also together with the private sector. So maybe we can provide that kind of information to you. Thank you very much. I hand over back to you, Joanna. Thank you.
Thank you so much, Bert. Okay, let's go through very quickly house rules before kicking off the workshop. So your microphone should be muted. Please also keep them muted throughout the workshop unless you're invited to speak. So for comments, questions, you can use the chat whenever or at any moment throughout the session. So just send us your comments, questions through there. But you can also raise your hand to signal if you wish to speak, especially if we are going through this. We have a Q&A session or a discussion session. Please raise your hand and we'll hand over the word to you at a suitable moment. And as mentioned earlier, we are recording this session and we'll upload the recording online. And okay, so let me then move forward with introducing today's trainer to you. So we have Koen van Baekel. He's advisor at Rebel Group and co-founder at Seroka. I think many of you may be familiar with him. We've had some webinars with him earlier as well, or at least one webinar, I think, and he was also in the e-mobility platforms Seoul workshop a few years back. So we're happy to have Koen back with us here. So Koen is a financial and strategy expert with 15 years of experience in financial structuring, procurement, and business analysis. He currently works as financial and strategy advisor at Rebel Group, as mentioned, where he's involved in urban infrastructure and transit-related projects. And he's also co-founder at Seroka, which focuses on carbon credit programs for e-mobility asset owners and operators. So without further ado, I guess I will hand over to Koen to take over the training session. So over to you, Koen. Happy to have you here. Thanks.
Thank you very much, Joanna, and thank you very much, Bert, for these kind introductions, and indeed thank you for having me over to be with you for this training session. I will share my screen. We have done the tech test before, so it should all be running smoothly, and you should be seeing my presentation on your screen, on your screens, right about now. So again, good morning to everybody in my time zones of the world, and good afternoon to Southeast Asia, East Asia, and good night and good evening to everybody in other parts of the world. And again, welcome to this training on project financing for e-mobility projects and indeed companies. And that already introduces a little bit of one of the main themes that we'll be spending some time on in the first part of this training. And we'll get into that in more detail. After this very brief introduction, we'll be sort of having a training session that's split up in two separate modules. One will target specifically questions of financing for e-mobility projects. We'll have a break in between the two sessions, and then the second component, the second session, will focus on financial modeling for the purpose of analyzing e-mobility projects. It's a fairly broad, financing is a very broad topic. E-mobility is a very broad topic. And then financial modeling is nice and concrete. So we'll go from scratching the surface across a whole bunch of topics and themes in hopefully a way that will raise some discussion, some questions, and will give you some answers to questions you might have held already for a long time. And then at some point after a 5-minute coffee break, we'll descend down to ground level and we'll talk a little bit about the nitty-gritty challenges and particularities of financial modeling for financing and for e-mobility projects. There is a Mentimeter involved, so we will be breaking up the monotonous ongoings of my voice with some form of interaction. That said, I know it's a long time to be spending behind the screen, so I will try to do my best and make this as interesting for you as possible. And of course, we will have Q&A sessions, and I think it might also be possible to interject the presentation with questions. I'll leave it to the moderator to be in charge of that. My introduction was, I think, quite elaborate already, so I'll just reiterate that I am working with Rebel in the capacity of consulting on strategy and finance questions for infrastructure and transit and mobility projects. And indeed, in the, well, not in the evening hours, but in my second 24-hour, 7 days a week persona, I also support the transition to e-mobility through very concrete financing interventions by carbon credits. So it's quite excited to be both sort of working in financing e-mobility projects in a consulting capacity, but also getting down to the ground of actually making finance reach projects that need it, and thereby accelerating the very important transition to e-mobility. And with that said, I think let's not pause any longer and get into the first component of this training, which is all about funding. And we'll talk a little bit about, about financing, and we'll talk a little bit about the definitional aspects of what is financing, what defines financing, and what sets it apart from funding, different types of finance, and especially risk considerations in regard of financing e-mobility projects. Talk a little bit about instruments and sources of financing, and then we'll get a little bit more into the structural questions of how to put project finance together for an e-mobility project. And of course, there will be ample opportunity for questions and answers and interaction through the Mentimeter that I think everybody by now, after a number of years of online meetings and video sessions, will probably know. If you proceed right now to mentimeter.com, you could enter this code, please, which is 36277253, and that would bring you to the Mentimeter session that I will be starting, which is to do with the questions that we'll be using Mentimeter for in this training today. And I will stop sharing this screen, and I will share the Mentimeter screen. And then with some luck, we should be seeing a lot of you joining. We have 39 people in this presentation now. So we should be seeing quite a few of you joining, hopefully the Mentimeter screen, which I am now setting up as well. So we'll give it a minute. Again, you should be seeing the web address, the web page address on your screen as well now, which is www.mentimeter.com. And when you open your browser to that page, you can use the code 36277253.
And I have copied in the code into the chat, and you can also just use the shorter version of the website. So it's menti.com, should take you there as well.
Thank you for that, Joanna. That's very right. And I see we have some people joining already. We have 14 people in now. And so I'll give it maybe one more minute. So it's menti.com or mentimeter.com. And the code would be 36277253. And the question at hand, and it's good that people already have taken the initiative to start to answer that question, is a very basic one. Why would we undertake finance in the first place? What are we getting at? What are we trying to achieve? So I've got 4 responses out of 18 active users now. So I would invite everybody to have a sip of your coffee and to tell me what you think the goal of finance would actually be. So give it some thought. I think I have now 8 answers out of 21 participants and 1 thumbs up. That's very encouraging. Thank you so much for that. So I'll give it half a minute more, please. Please let us have your thoughts. What are we doing this for? And why are we in this session in the first place? What are we trying to get at? Great. A lot of things, a lot of responses related to actually getting something done, realize it, making it happen, realize the goals, implementing it. I think that really represents the critical role that financing plays in getting e-mobility projects off the ground. So e-mobility projects require investments. They require a lot of money at the start, at the outset, and so it is very right that it's a vital, critical element of these projects. I'm trying to reiterate the other ones I see coming in, but every time a new one comes in, the whole word cloud turns around. It is about making projects sustainable. It is about profitability. So I suppose indeed financing works if a project is profitable, can be realized profitably. If not, there's no need or there's no real sort of perspective on raising finance, because who would put money into something that doesn't pay itself back? And we'll speak more about that later. You need a stable project. It's very interesting because it speaks to the kind of uncertainty of the future and the risk of, if I put money in today, what will happen tomorrow, next week, a month, a year from now. So we'll talk more about that fundamental aspect of risk in financing as well. So a lot of good answers. It's 20 out of 24 responses now, and I think that's great. I welcome you all to the presentation again and to the Mentimeter page, and I will be proceeding now with the presentation, but I think a lot of important themes were touched on here. So that's lovely because it also triggers me a little bit in terms of the rest of the presentation. So we're back in the presentation view and touching first a little bit, I think, on the definition of what it really is financing. And how we typically do that is by distinguishing between financing and funding. And funding really, we would typically say, concerns the basic business case of the project. It concerns all of the flows of monies into and out of the project. And primarily that would be the flows that are inherent to the investment for the project, setting it up, running it, operating it, maintaining it, whatever the assets are or the infrastructure is, and any income that flows or that results from the project or the company that could be used to cover any costs in any particular quarter, month, or year, as well as over the life of the project. So in the case of a road, that would be toll fees. In the case of an e-mobility project, it could be lease fees, or it could be payments for energy charged to a public charging point. It could be an availability payment for fleet assets or for infrastructure assets. So there's really, these are the flows that are inherent to getting something done, which produces something of value, which people are typically willing to pay some money for. The problem, of course, is that getting something done, and this we saw also, I think, in your word cloud responses, getting something done involves putting money up at the start without there being a corresponding amount of money to pay for that at that very moment. So financing solves that problem through providing temporarily the funds that are necessary to set up the project, to undertake it. And of course, those funds are provided temporarily and need to be returned over a period of time. And there is a return involved as well, a risk premium or a reward, a compensation for the temporary provision of the money, whether that's loans or equity. We'll talk a bit more about the instruments, but really the key thing I want you to internalize, if you haven't internalized it already, is that financing is nothing more or less than solving funding problems that involve what you see here on the left, cash going out for investments, for buying something, for purchasing or building or constructing or implementing it in the first several years. and then only having value or revenue or income resulting from that in the later years. And the graph on the right illustrates what financing does. It brings in corresponding funding flows that allow you to make those investments in the initial years. And it takes back that temporarily provided funding in the later parts of the years. And it is important to understand the fundamental nature of risk in that regard, which would occur as soon as my PowerPoint slide allows me to move forward. And of course, now it jumps forward a couple of slides. The key thing that one has to understand about risk and financing is the uncertainty of what happens in the future. We're being asked in financing, we're asking somebody, let's say, to put money up today, only to recover that money in an uncertain future in 1 year, 5 years, 10, sometimes 15 or 20 years from now. And so that creates a whole lot of risk. And that risk is typically why financiers, whether it's equity finance or debt financing from whatever source, will require some type of compensation in the form of a return. Because after all, there is uncertainty, increasing uncertainty as time goes by. And there's other ways of investing your money besides this project or this company. And so we would like, from a financing point of view, to receive a compensation for taking the risk, for exposing ourselves to this uncertainty. And that is really what risk is all about in financing. And that is really why there is interest payments, why there are return expectations, why there are rates of returns being calculated, and everybody goes on and on about the nitty-gritty, intricate details of the terms and conditions of financing projects. And that's great, because that's the topic of today a little bit. So we do get to have our way with those. Important to distinguish, the theme of this training is somewhat liberally, I think, chosen as project financing of e-mobility projects. I do feel it's important for you to understand a little bit the difference between corporate finance and project finance and asset finance. There's a bunch more classifications that can be used that add more detail or nuance to these three, but I think the key differences between these three are quite instructive because of the recourse and the risk profiles of what happens. So in corporate finance, we're talking about a company, a corporation that is an established, let's say, going concern company. It has a balance sheet and a portfolio of a number of business activity or divisions of projects. And so it's really a bit of a mishmash of different things happening within the boundaries of that company and its balance sheet. And so corporate finance typically involves the company going out and attracting bank loans or issuing bonds, whereby the risk of providing the company with that money through a bond or a bank loan is only really secured by what the company has in terms of assets on its balance sheet. So there's recourse to the company assets, and we see that very typically when a company goes into default. It will be the financiers and especially the lenders that are first in line to unpick the company's balance sheet and sell everything for whatever it's worth in order to recover their debt. So that's really the nature of corporate finance. It's financing most typically against the security of being able to go after whatever the company owns in case the loans aren't being repaid and the interest payments aren't being met by the company. So there's not really a clear single point of recourse that somebody can grab if the loan is not being paid. And there's not really a clear exit. There's often rollover and refinancings of bank loans on balance. And so that is really the nature of corporate finance. And it's different from project finance shown here in the middle, because in project finance, we say the project borrows. And the project in this case, very typically in project finance, is a legal entity, and thereby could also be said to be a company. It would be a limited liability company or a similar legal form. But that company or legal entity would really only be set up for the purpose of a single project. And so there's one project at stake, there's one cash flow, one set of project cash flows, let me say it like that, going through it. And so the recourse typically in project finance is not to anything else but to the cash flows going in and out of the project entity. So only the cash flows related to the project, which puts a lot of focus on the basis for those cash flows, which is typically in project finance, in public sector projects, in PPPs, it would be a PPP agreement. So you get a pretty elaborate, intricate management and allocation of risks through a PPP agreement, because really the only recourse that investors and financiers have, and the only security to some extent that they have against the risk of putting money up for the project, is that they have a contract that says you have a certain promise or projection of revenue from only this project. And so that creates a focus on a single project of a limited lifespan, often typically matching the time it takes for the investors and the financiers to recover their investment and earn the required returns. And it thereby also has a clearly defined exit. And it is for anybody else involved, not on their balance sheet. So the investments, the obligations, the liabilities of the project, to some large extent, will remain only on the balance sheet of a project entity and will not occur on any other's balance sheet or risk accounting. This is a simplification because this goes for the risks and the assets that stick with the project. But let's not get into the too technical detail for the purpose of this training, because we also want to spend a moment talking about asset finance on the right here, which is where financing happens through a loan or another form of debt for a specific set of assets. And so you get, for example, a fleet of buses, or you get a set of charging infrastructure. And the difference between the brothers and sisters on the left is that for asset finance, the financier has recourse to the asset. So the asset is collateralized or in another way encumbered, so that the security of whoever borrows the money to purchase the assets, in case the borrower does not repay the loans or the interest payments, the asset financier has recourse and will grab your buses, for example, and sell them for market value in order to recover their money. So the difference here is that where in corporate finance, if something goes wrong, the borrower comes and has the possibility really to take part or the whole of the company's balance sheet and sell it off in order to be made whole. In project finance, the security is really in having a contract in place in the context of PPPs and infrastructure projects, having a contract in place that gives you sufficient security that you'll be able to recover your investment and earn your returns and receive your interest payments and all that. And in asset finance, a key piece of security is to have recourse to the asset, which gives you a focus on asset-related risks, which gives you a focus on the lifespan of the asset and matching how long you're going to take to get a loan repaid, to matching that to how long you think you would use the asset. For example, how long will you use the bus, and what does it take to repay a loan related to purchasing that bus. And it is typically something that is recognized, for example, if we are talking about lease financing, on the balance sheet of a legal entity of a company, because it represents a fixed obligation, and it is not something that is even if it's an operational lease and you don't own the asset, it is still a fixed obligation that under most accounting rules needs to be represented on your balance sheet as such. Very basic distinctions. In practice, you'll see a lot more blended or more hybrid forms. There will be recourse to project assets in project finance. There will be parent company guarantees issued in case of asset finance or project finance. So the reality is, as always, a little bit more complex than this, but these are, I think, three very important distinctions to make, because they represent also some of the basic approaches to finance that you see in e-mobility companies and in e-mobility projects. few additions on corporate finance. There is, which is mostly what I just described, the very boring going concern form of corporate finance, which involves a mature company in a mature market. For example, in the case of e-mobility, and it would involve an existing automotive company in a mature market, entering e-mobility assets and deploying them using the strength of its balance sheet and its credibility and reputation in the market, which is different from what we also see in some markets, in some sectors. Startups developing an e-mobility activity, for example, in two-wheelers or three-wheelers, or rolling out charging networks, and therefore having a higher risk profile because they don't have much to offer on their balance sheet by way of security or recourse. And so, it's typically a higher return expectation, and we call that most typically venture capital type finance, and return requirements would be, up to a multiple of 10 or more of the initial investment if you enter early in the life of the new company as a financier. So again, some nuance there. Corporate finance can be any and all of these forms, but it's important to understand that the exact shape and terms and conditions that it takes depend on the maturity of the company. It depends on the maturity of the market, and whether, for example, if we're talking about buses, whether there is a secondary market, or whether there is no real secondary market for second-hand deployment of vehicles after the initial purchaser defaults. So let's say a purchaser of a bus fleet defaults on its loan obligations, and the buses are seized by the financier. That in and of itself has little value to the financier unless it can have those buses redeployed by a third party, even though they're second-hand buses. Now, for assets that people know, for diesel buses, for gasoline vehicles, there is a well-known secondary market in most, if not all, countries. And so, going rates are known, valuations are known. So that's a risk that even at the start of an e-mobility project, borrowers and lenders are able to negotiate and to agree on. But in some cases, in the case of e-mobility projects, there is only now in some markets an emerging secondary use case, a secondary market emerging for e-mobility assets. And that makes it tricky, because without that, there's always the question of if I now have to do something else with this bus because the loan isn't repaid and I need to seize it as the lender, am I going to be able to earn a return and be made whole on this financing through the residual value of the bus? And in a little bit of a similar way, this also applies to maturity of technology. So in e-mobility, some of the technologies that we are looking at are relatively new and they are yet to be adopted and rolled out at scale. Whereas some others are fairly straightforward and also less risky and less capital intensive to roll out. And so this all plays into the perception of risk, and, if you will, the anxiety of and the fear of financiers in entering into financing for e-mobility projects. Whether you're talking about corporate finance or project finance or asset finance, there's always a basic distinction between whether it's a relatively low risk type of financing, in which case it's often referred to as debt, or whether it's a very high risk financing, often referred to as equity. Now, debt is something where the rules of the game are fairly strict. You receive a sum of money from your financier, from the lender, and there is a very fixed agreement in most cases where you repay according to very clear terms and conditions over a very clearly agreed upon time, that debt plus an interest plus fees and other related bits and pieces. Whereas on the other side, equity is something that takes all the risk and stands all the way at the end of the queue. So only if the project becomes really quite profitable will an equity investor be able to take to recover its investment and make an appropriate return on that, which as a return on putting your money in as equity is then also going to be a lot higher than if you put your money in as debt, because debt takes a lot less risk. You will typically see that debt providers will make very strict agreements, terms and conditions with you. They will try and get you to encumber and collateralize and provide everything you own. They will require you to remortgage your house, and they will really not be in the business of taking risk. But then also the return they require, the interest rate and related aspects will not be as high. Whereas in the case of equity, the return expectation, the compensation that one expects to receive for putting finance, for putting money in as equity will be a lot higher. And then there's various forms of financing in between those in terms of the risk that can also be thought up. And indeed, there's a rich variety of them. And it's maybe then as a final point to this topic important to keep in mind that when you talk about risk and you talk about return, there is a need for financing to be successful. There is a need to balance and to match a little bit the risk and the return. There is obviously a very bad deal being done if the return is very high, but the risk is very low. So if a financier gives you money and takes very low risk because there is a high certainty or a near certainty or a full certainty that the money will be repaid, that's a very low risk financing from the point of view of the lender, of the financier. However, if the return on that is very high because the interest rate would be set at let's quote a ridiculous amount of 20, 25, 30% all in effective interest rate, that's a very bad deal for you as the lender. It's a great deal for as the borrower. I mean, it's a great deal for the lender. But clearly, this being out of balance does not produce a really good outcome, and vice versa. It's a very bad deal for the lender if the interest rate, if the compensation, if the fees for the risk being taken do not match the amount of risk to which the financing is being exposed. And so, in that case, you will very often see that it will not be possible, it will not be viable to attract that financing for a project. So it's very important to keep that very basic concept in mind, that when undertaking financing of a project, it's important that there is a balance at different levels of the risk that you can sort of piece up and carve up in different risks. There's a balance between the return expectation and projections and the risk exposure. Now, after all that theory, and to break a little bit the monotony of my voice, I'm going to switch you back to the Mentimeter again, which I hope you would still have open to help me answer the following question, which I will now also skip to, and that would be. Mm-hmm.
No, sorry, Koen, I was just going to say this is the same code, right?
Yes, it would be the same code indeed. Yes.
Perfect.
I'm just going to stop my share here. So please, I would request that everybody return to their Mentimeter web browser. Again, menti.com or mentimeter.com if you haven't opened it already. And the code is 36277253. And we have 25 people in there now. That's great. And would you please help me from your point of view answering the question of what are very specific risks that you feel are relevant or that you have encountered in financing of e-mobility projects or assets or companies. So don't overthink it. Just throw the first or a few of the first really challenges related to risk in there that you see. Yeah.
Koen, while we're waiting for responses, there was a question that came in at one of your earlier slides when you talked about the project versus corporate versus asset financing in the chat. So the question is, for project finance, is it necessary that a separate entity is established for the project? And Anusha, if you or if you need further clarification, maybe we can ask Anusha to write or raise her hand.
Okay.
But,
okay. No, it's quite all right. So the typical form of project financing requires that the project is ring fenced, right? So in a company, you would have activities or projects that kind of all sit together under more or less a single consolidated company balance sheet. So it's in one entity, but it is a bunch of things together. And so it kind of gets mixed up. It's meshed a little bit in terms of the risk, because you couldn't really set one piece of the company's balance sheet aside and say, well, this is now only, your risk and this is somebody else's risk. Whereas what we do in project finance is we set the project aside. And one of the most effective ways of doing that is in a separate legal entity in a special purpose company. So that company, the legal entity, is specifically set up for the purpose of undertaking the project and for taking the risks, only the risks for that specific project, and managing those risks and making sure that, it's clear who takes care of, the problem if things go wrong, who takes the pain if things go wrong. And so in nature, that's a very different way of setting it up from how corporate finance works, or even how asset finance works. And we call that in most cases non-recourse finance. So the only safety and security you really have is, in the case of PPPs, that this separate company, this separate legal entity, has some form of a PPP agreement with a government or a public sector client, usually related to that project, and allowing it to receive revenues or income from only that project. And that's the key difference. So there are for sure other forms of doing it. All of them would involve ring fencing or setting aside very clearly, in a very robust way, the cash flows and the risks related to one specific project. But in nearly all cases, the setting up of a legal entity, a separate limited liability legal entity or something similar, is what's being done. After that question, I am so thankful for already 18 out of 29 participants sort of throwing all the risks at me that they see in financing of e-mobility projects. There's quite a lot of them. I don't think I can really organize them and drag them around. So I just have to kind of skip through them a bit as we do. But there are some interesting ones. Yeah? So battery life in the case of electric mobility is, of course, key. Used to be quite long, difficult to match often, for example, in the case of bus concession projects to the life of, to the typical term of the concession. Battery life tends to be longer. Tends to be shorter than the concession requirement. Things are changing, so we see in technology trends also, of course, the increase in capacity and life of batteries, allowing us to also to also reduce residual value risk of buses in case of a default or in case of the termination of a concession contract. In the case of buses, there is the uncertainty of the timeline of your return on investment in e-mobility, especially when it's an emerging market, when it's a relatively new technology, or when you have indeed unproven battery life aspects. It's difficult to tell when exactly the business case will be reaching the point where your return on investment is achieved. So there's always the fundamental risk of, in e-mobility, in some cases, it's not easy to look ahead. It's not easy to say for the next 5 or 10 or 15 years, this is what's going to happen, compared to, for example, a very run-of-the-mill PPP project that is based on a road being constructed and the government paying capital or availability payments for the road over a certain amount of time. Very different risk profile. Battery life and also, of course, connects very nicely to battery end-of-life processing. What's the requirements in years from now as to processing, disposal, and recycling of batteries at the end of life? This is, of course, being worked on across the world, but it is an aspect, a question of risk, and it's also a question potential of upside, because in many projects in, for example, public transport, there will be residual state of health of batteries at the end of life, which gives them a residual value that's not zero, but that makes it possible to redeploy them for other purposes. I'm just going to skip through them because I realize we're scratching the surface on so many things here, and there's only a limited amount of time. Residual value risk is one that's definitely key. I already mentioned it. Should something go wrong, what is the value that can still be extracted from an asset if the asset is used? Asset utilization risk is always there, of course. When you finance an asset, are you or is somebody else going to be able to use it and use it economically, profitably, so that the value is generated and allows you to meet the financing repayments and interest payments? Volatility is an important one. It goes again to the key aspect of the uncertainty and the fear we have of the future. If we have a very stable revenue flow, for example, because we're installing a charging network, but there's a minimum revenue guarantee from government, we kind of know what's going to happen, and we have a floor, a baseline expectation of, with the minimum revenue guarantee, at least we will always be able to meet most, if not all, of our financing requirements. But if there's no such thing and the revenue is considered more volatile because of market movements, because of competition and the uncertainty around whether competitors will also emerge, this makes financing a lot more difficult, and it will require probably less debt financing, more equity financing, less leverage, high risk, high returns. It will make the project more expensive. And so these are all very, very good answers. Very, very, very useful. Very, very meaningful indeed. Currency risk. Indeed, if you're borrowing in foreign currency and the investment is made largely in domestic currency, that is a problem. If the borrowing is done in foreign currency and the revenue is earned back in domestic currency, that's an even bigger problem, of course, because then you'll be probably repaying your borrowing in, for example, dollars, but your revenue would be in local currency, and so any change in the exchange rate between the local currency and the foreign currency would create a problem and would be a risk. And there are ways of mitigating that, of course, through currency hedges, but they're not available for any and every currency in the world, and they're certainly not available for free. So they also, again, if you want to deal with a risk like that, it raises the cost of the project. Many more answers, for which I'm very thankful as well, and we can discuss them if they're raised in the Q&A as well. Johanna, keeping an eye on the time now, I think I will return everybody to the presentation to continue, in order to keep a little bit to the timeline, but also not to scare too many people away from financing e-mobility because it is so risky. There we go. So there were hardly any wrong answers in the responses just seen in the Mentimeter, but just to kind of give you a summation of some of the key risks that we typically see happen from a financing point of view, and they were all mentioned, I think, in the Menti. So we are dealing with market and demand risk. Obviously, where's the market going to go? Is there going to be demand for this activity or this project? And where's the technology going to go? And in project, that's the case of corporate finance. In project finance, the focus is, because of the nature of project finance, more on the revenue flow related to the project. Is it volatile indeed? Is it going to be sufficient enough to achieve return on investment within an acceptable time frame? And if indeed, in the case of PPPs that are being project financed, what's the counterparty risk? Can I trust the government side to meet its obligation? If it's local government, can somebody else, maybe at the national level, provide an additional guarantee that safeguards the contractual obligations of the local government that signs the PPP agreement? So these are all, especially in PPPs and in project finance, very typical questions, and they're all focused on what happens to the project, nothing else, just the project. And then in asset finance, I think there are a number of them, but the residual value risk, is there, if something goes wrong, still a value to be extracted from this asset, from this bus, from this charging point, from this vehicle, is key to financiers being able to assess where the attractiveness and the viability of providing finance, providing asset or lease finance for a project. More concretely, again, for 2 or 3 wheelers, demand, will it pick up? I think a very key question for 2 or 3 wheeler startups is always, are you able to build up and lock in local market share? Are there issues of technical compatibility with the battery form factor, with the charging systems being rolled out? So these are very sort of strategic market questions typically seen for startups. For charging network deployment, again, I mentioned already the issue of the minimum revenue guarantee, the sufficiency of revenue over time. And indeed, in the case of the residual value risk, there is, in some cases, an emerging potential secondary market for electric vehicles. But again, that's different whether you're talking about light-duty vehicles or heavy-duty vehicles, private EVs or buses. And so these are really very specifically for e-mobility, some of the key risks that need to be addressed and mitigated in financing e-mobility projects. Oh, bit bumpy. Quickly, because I think we're taking quite some time, and that's good. Some listing of the different types of financing instruments and sources that we would typically distinguish between. There's always more nuance and more complexity, but to just give you a sense, I think it's useful to distinguish between commercial debt, which is your local or international banking system, corporate wholesale banks being able to provide project finance or corporate finance to companies or projects. And again, debt being debt, it means low risk, low return. They're gonna ask you for everything and anything. In the case of bonds, it's a fairly complex thing to structure, and you can achieve scale a lot more easily. But the transaction structure and the difficulty of setting it up and getting it accredited and checked is a lot higher. So it needs to bonds really only work if you have a fairly sufficient volume of financing that you need to undertake. Then there's public and institutional finance. There's obviously sovereign finance that can be provided from government directly or from sovereign investment funds that are set up to accelerate certain transitions or meet certain policy goals. We are in an ADB training, so one could not go without mentioning the very significant role played in large parts of the world of multilateral finance institutions such as the ADB, the World Bank Group, the African Development Group in accelerating the transition to e-mobility through financing that is in many cases slightly better priced and a little bit more forgiving than commercial debt. Equity again is across a range of different providers, whether it's private equity or venture capital investors or impact investors, a source of financing that is accepting higher risk and better able to deal with more scary type, more uncertain type futures, but therefore also requiring a higher return for that. There are a couple of very specific climate and carbon finance instruments, carbon credits notably, and the climate funds and related initiatives. And then there are a range of insurance and guarantee products provided by commercial institutions or by, for example, MIGA or related entities in the multilateral system that allow you to insure against or to mitigate certain political risks or contractual risks so that the financier is not exposed to that. Key distinctions for all these, I think, that are to be made is whether the financing is funded, whether they involve the provision of funds, which is in most cases, of course, what we want. We want to solve, if you think about the first part of this training, a funding problem because we want to purchase something or install something, we need to invest. So we need investment funding. And so that's why we go out and raise financing. But in the case of risk management, that's a financing instrument that's not funded. It's something in most cases that doesn't involve the movement of funds from one account to the other. It's something that costs money. You will have to pay an insurance premium or a similar fee, but it's not something that at the outset involves the movement of liquidity. Only when a certain risk occurs does it get triggered and will the guarantee or the insurance pay out. And so thereby it is contingent. It's depending on a risk materializing or occurring, really. And then the other result, I think, is that's quite key, is whether the financing is disbursed upfront, which is what we need in most cases, or in many cases, when dealing with climate and carbon finance, it might also be result-based, in which case it is disbursed as results are being achieved. A distinction is also then between the return and the risk, or from the point of view of the borrower, the risk and the cost. So keep in mind, again, the different risk and cost profiles of the different financing instruments, I would say. And with that, also keep in mind that I think this is something that governments typically tend to ignore. So I'll highlight that one. If you look at government finance, we typically tend to think of that as cheaper than private finance because the interest rates are lower. But it also means that governments tend to have less of an incentive to finance effectively and to manage projects effectively. Because after all, the risk that's related to the project is just one risk against the whole set of activities and things that the government does. So it can be diversified away relatively easily. However, at the level of the project, it simply means that you're more tolerant to risk, you're potentially a little bit more sloppy in managing your risks and executing the project. And so typically it results in higher costs after all. So the real cost of a project is always commensurate, always corresponding to the risk profile of the project. Whether you think you're able to finance it cheaper or not, the risk is really what drives the cost of the project, because it drives the uncertainty and the volatility of not the right word, the variability of the future outcomes of the project. And that's where the real cost sits. I think I'm running a little short on time, so I'm going to skip through the different examples that I have here. I already explained a little bit about about bonds in general, and I think green bonds is a very nice subcategory of that. That are used for financing large projects and large corporations, also in e-mobility, and the difference between bonds and bank loans. It should be mentioned that especially development banks and multilateral institutions are actively undertaking climate-related loans, green loans, that are also being taken up for low-carbon transportation projects and activities. There is an increasing trend by local and regional authorities, so sub-sovereigns, to issue bonds as well. So you will see municipal bonds being issued. We already mentioned the pure forms of multilateral and bilateral development finance, which are often extended through governments or directly to projects at lower, more attractive prices, and with longer grace periods, longer repayment periods. So that's often something that can be used to de-risk and to crowd in commercial finance if you combine the two. There is a large amount of impact investment equities, equity investors, and commercial equity investors working on electric mobility, on green startups, and on related activities. And so I think a nice example is the Green Investment Group set up by Macquarie, which was set up as an equity investment fund in EV infrastructure, and which was structured as a combination of a number of finance sources that are specifically targeting green projects. Something that, as I mentioned, we work a lot on at Zeroka is the development of carbon credit programs that monetize emission reduction, so that companies investing in e-mobility can earn an extra carbon finance related return from the actual emission reductions being achieved over time. And that's quite interesting because it doesn't put a strain or an expectation on future cash flows for repayment or interest payment. So it's really an additional, let's put it a little bit unelegantly, free source of revenue that can be used if one is able to develop a carbon market project successfully. And that's something that we, but also others, are involved in. And I think at this point, it might be good to switch back to the Mentimeter question again. And if you switch back to your Mentimeter, you will now see the next question on your screen. And that question is about the potential, the revenue potential of, see, where do I have it? The revenue potential of a carbon credit project for an e-mobility company or an activity. So there are different price points whereby if you could say, if you reduce CO2 emissions, what is the expected revenue and for e-mobility projects? And that's the revenue per ton of CO2 emission reduction, which is the most common unit of calculation or unit of measurement of emission reductions for CO2 emissions.
And Koen, I don't know if to manage time perhaps a little bit, there are further questions in the chat, so I don't know if we take one here in between and then while we're waiting for responses.
Yeah,
so
it's good. We can take one. Yeah, yeah.
Yeah. So how does guarantee against political and other risks work in practice? Question by Glinda from Clean Air Asia.
So there is a distinction in most cases between partial or political risk, let's say political risk guarantees and partial credit guarantees. So there are, for example, MIGA and others, there are institutions providing very specific guarantees to project lenders, protecting those lenders or insuring effectively. You should think of it as an insurance, insuring those lenders against the default or the breaking of its contractual obligations of a government in a PPP project in most cases. Of course, it doesn't come for free. It's priced. It requires a premium or a type of fee being paid. But it doesn't. It's important, I think, to underline, if anything, that those insurance products, those guarantee products, always cover very specific categories of risk. It's either a political risk, in which case it's a contract not being honored by a government, or it is partial credit risk, in which case it would address partially the debt financing being extended and being provided to the PPP. So it's not a blanket guarantee just in case anything goes wrong, but it's quite specific. Moving on, and I think there's more questions that we might address in the Q&A, Joanna. It's nice to see the responses on the screen of the menti.com right now. A lot of variety in the price points. I think I have entered a value that we know, or a bandwidth at least, that we know to be achieved, which I put at the center point of $35 per ton of CO2 emission reduction right now. But we know that those prices are also moving. So we know that if anything, the expectation is, of course, that the effective price, the social value of carbon is moving up from here. We know that e-mobility projects, especially under the Paris Agreement carbon markets, which are emerging, earn a lot higher price points compared to many projects that are set up on the voluntary carbon markets, which are closer to your $5, $10, or $12 per ton of CO2 emission reduction. So between carbon markets and the different types of projects, there's a very big bandwidth. But it's just to illustrate that if you do this for a sufficient number of vehicles and a sufficient number of emission reductions, this is a quote-unquote free source of revenue, which can make a difference for e-mobility investors. It doesn't turn your business model upside down, but in some cases, on the capital value of your investments, it can add a 10% extra source of revenue over time. That said, I will return again with thanks for the responses to the presentation here. And we'll also highlight, as I mentioned already, that multilateral institutions are active in developing climate finance funds. I think we cannot have this presentation, Joanna and Bert, without mentioning the FP225, the mobility program set up by the ADB and GCF, which commits nearly $500 million to submit zero emission transport in 7 countries in Asia. And there are many initiatives like that, and I think the GCF is doing great work in offering this kind of concessional finance to e-mobility and carbon reducing projects. We spoke a little bit about the guarantees and risk mitigation already, so I'll skip past that one a little bit. And I just wanted to give you a look and feel of a typical project finance structure. So this is taking not corporate but assets. Not corporate or asset finance, but project financing, indeed as a separate company, whereby The investors are very often also involved in the management of the project, especially the equity investors. So you really get the experts, the guys who know what they're doing, to take most of the risk. And you see already the contractual complexity in the number of agreements involved in setting this up, and all those contracts, and I won't mention all of them right now, but you can see what's happening here is around, just for this one project, a very specific, very targeted allocation of risk, carving up of risk by all these different contracts to make sure that everybody does their job, the job that they do, that they do best, and that everybody takes on the risks that they are able to manage best. And by doing that, by so meticulously structuring and carving out those risks, it typically allows, for capital intensive projects, for projects that require a lot of investment money, to put in a lot of debt. And to put in a lot of debt is nice relative to equity, because it means putting in relatively more cheap finance relative to the more expensive equity finance, and thereby it lowers the cost of finance of the project. So it puts it off balance. It uses the competences of every player in the best possible way, by giving them the incentive to do a good job, and in other words, also to assign to them the pain and the hardship if things go wrong. That is what we call sharing of the risks, and it enables higher leverage and lower cost of finance. And the theory is really that by structuring the risks like that, and by increasing the role of debt finance, which is, as we said, debt finance is very averse to risk and uncertainty. You bring in people who are very keen that the project is managed professionally, that the right people are investing and managing it, and that nobody messes it up, so that over time the debt finance is being repaid. So this is the fundamental nature of leverage and the value effect of debt finance in PPPs. The structure then is complicated, not only in terms of the entire set of agreements that are necessary around the SPV, but also even in terms of the financing agreements. It gets quite technical. I think it's a little bit too technical to go through all of these right now, also in the interest of time, but I'm happy to answer any questions that people might have. One example is the case of Santiago, where it's interesting that there was a combination done of multilateral finance from IFC for the purchase of e-buses, which enabled more private finance to be brought in from third parties. The experts, the local utility company in the case of Santiago, and a local vehicle importer, so an automotive company, basically taking most of the equity risk, an SPV that allows you to undertake project finance and to increase the leverage and lower the cost, and to de-risk the volatility or the variability of revenue outcomes, of revenue projections, a revenue guarantee from national government, so that there's a kind of floor under what is expected to come in as revenues over the next 14 years. So that's an interesting example. It's a different example, I think, from the previous training session on business models for electric buses, which I think quoted an example from Santiago that was done before, also featuring the local utility company, which was more directly involved in using its position as an energy provider to raise finance and make available electric buses. This one, I think, scales it up to nearly 1,000 battery electric buses and related charging infrastructure, and is dated from a more recent point in time. And now to wrap up the financing challenges session, Joanna, I have one Mentimeter question left, which is, what are financing challenges that the participants have encountered? So I invite them again to go to their Mentimeter screen. I will do the same, and I will skip the Mentimeter through to that question, which again is, what are, dear participants, the financing challenges that you have encountered in e-mobility projects, in e-mobility companies, or in related situations in financing e-mobility assets or activities? So again, that's mentimeter.com or menti.com, and the code is 36277253. We have all of 30 participants right now, and I invite your responses And in the meantime, Johanna, maybe it's good practice to again take a question from the Q&A.
Yeah, let's take a question from the Q&A. So there's a specific one on carbon credits, and it's Anusha asking, what if a company is not producing the EV, but manufacturing the components for EVs? Would carbon credits be applicable in that case?
The answers are both yes and it depends. So the default, let's say the default situation, not even from a legal point of view, but rather from how carbon credit projects are getting checked and validated and accredited, is that the owner and operator of a vehicle holds the right to the emission reduction related from the use of the vehicle, the electric vehicle. However, owners of vehicles are, of course, quite often not in a position to monetize to create a carbon credit program because they don't have the time and money to set up a program for a single vehicle. So what is possible is that right is transferred to, for example, the dealership selling the vehicle, or the OEM selling the vehicle, or the lease financing the vehicle through a simple piece of legal agreement included either in the contract or in the terms and conditions of use, whereby the end user or the purchaser of the vehicle agrees to the transfer of the right, let's say, to monetize emission reductions. So the short form of that answer is yes, it is possible.
And Koen, maybe just quickly another question. Although I see we may not be getting a lot of answers on the Menti here, but can a financier become a company shareholder after the initial finance is recovered? And do e-mobility projects offer any opportunities as such? Maybe a very short answer, because I think we're running a bit behind in schedule at the moment.
In finance, everything is possible if people agree to it. Finance is contractual, so you enter into a contractual relationship, and if all parties agree to a third party or financier after the completion of the repayments and all the other obligations becomes a shareholder, then that is in theory and technically not at all impossible. That's quite possible. There is a natural mechanism, for example, where financiers provide convertible loans in which they can for different reasons convert their financing into shareholding, in which case that's kind of the way the risk is being managed a bit more. So those are very specific finance instruments, the convertible loans. So that's also a scenario. Maybe that's where the question is coming from. But yes, it is possible. Then in the case of the Menti question, the financing challenges encountered are not as many as the risks being mentioned earlier, or the other responses. So that's potentially good news. It means that we are facing fewer and fewer challenges in getting e-mobility projects financed, and I think that's not something that I would be entirely surprised by, because it does, of course, underline the maturity, the increasing sort of maturity, the familiarization of financiers with e-mobility assets. And that's probably an important theme, because in many countries, until not so long ago, banks simply had no understanding or no technical expertise even in e-mobility assets. And so, a bank lease department or a lease financier needs to also gain familiarity with, and gain comfort with, and gain a sense of this is where the market is at and this is where the technology is at before they're able to finance. So that is a real phenomenon in the markets, and I think that's also illustrated here, where one of the respondents says that it's really to do with stakeholders on familiarity and lack of familiarity with e-mobility markets, and there being a lack of financing schemes and options. Therefore, so that's real. Another one being mentioned is banks stop lending to transport cooperatives for the acquisition of electric vehicles because of non-payment of loans. Not clear from the question whether that relates to non-payment of loans on regular, so non-EV, but fossil fuel vehicles, which in which case it's more to do with the general creditworthiness and credit standing of those cooperatives. So whether that concerns the financings that were done already on the for example, initial acquisitions of the electric vehicles. But that's a real case of potentially a financing that was not structured well, and that's really hurtful because it dents the confidence of, I guess, the local market, in this case, the local banks in financing electric vehicles. And then the other solutions need to be found when it concerns specifically financing or transport cooperatives. And then it really goes to how are cooperatives structured? Are they legal entities? Do they have a balance sheet? So the cooperatives, of course, they're throughout the world, they're formed in different ways and shapes, and so that determines also a little bit the way forward from there. Projects are often not big enough to justify expensive project finance structures. That's true, and in that case, project finance is probably a bad idea, and you want to be looking more at a combination of corporate and asset finance solutions. So indeed, project finance really makes sense when you're able to undertake a pretty large capital intensive project in one go. And otherwise, you're setting up a structure that is complex and difficult, and maybe not fits or works for the purpose very well. This goes for project finances and for PPP projects in general, by the way, as well. Again, thank you for those challenges. I will proceed back to the presentation. I think we are also with that approaching the end of the first part of our training session, and for time management, Q&A management, and for announcing a little coffee break soon, I will leave it for a moment to you, Johanna, because I've been focused more on the screen than on the clock. So you got to tell us a bit where we are and how we go from here.
We actually only have around 15 minutes left for the whole session, but we could run a bit over, just to, if it's okay, Koen, for you as well, to run through
Sure.
a bit more, maybe a shorter version of the second part.
Yeah.
For those who have to leave at past, we will be recording this and sending the recording to registered participants, and it will be available on our website and online on our YouTube channel. So you will be able also to watch the recording, but also let's keep it maybe to max 10 minutes over time, so we don't exhaust yourself and
Sure.
and anyone in the part as part of the participants. I think we have exhausted the questions from the Q&A actually at the moment. So I would suggest that we perhaps either move directly or take a 2-minute break for people to grab a glass of water. I'm not sure if there's time to make yourselves a cup of tea or coffee. I'm getting a comment that we should move directly. Maybe we move directly to the next session, if that's okay for you, Koen, as well, since we're really running out of time. So yeah, I guess those breathers can be then taken after the session. So we have 20 minutes left. Let's put it that way. If you're able to do the second part a bit quicker, that would be great.
Sure, that's fine. The second part is shorter, and I apologize if I've now deprived anybody from their well-earned coffee break, and that includes myself. All fine. So we have 20 minutes left, and I think that's more than enough to deal with the more down-to-earth topic of financial modeling for specifically financing of e-mobility projects. We'll look a little bit at the context of why would you undertake a financial model, why would you build it, how is it being applied, and then goes a little bit more into the concrete details of how we typically set up and design models, how we use them, and we'll look a bit at an example of use. So typically for raising finance and for fundraising for e-mobility projects and companies, you'd see 3 bits of information being required by financiers. The business plan that kind of sets out the rationale, the market orientation, the growth strategy, etc. The team in case of a VC type question. Then a financial model that is covering the financial aspects of the business. It's usually done in Excel, an Excel spreadsheet format. And this model details the expected investments, the operations, the business drivers, the market projections, and finally the returns that financiers and investors can expect. And it demonstrates the ability of the project or the company to meet financing obligations and to repay financing and to pay returns and interests. And so it's therefore very much around the financial life, the funding and financing life of the project or the company, but it should correspond, it flows from, it builds on very logically the business plan component. And it produces outputs which can be used also in the investor presentation, which is usually a more short form pitch deck or a memorandum form information document that is being provided either to investors or to financiers alongside other backing up documents in like the financial model, but also other documentation in a data room of some form of the other. So this is these three are kind of interlinked documents. They're usually developed in a alongside others in a more or less iterative way, and they're living documents, so they get updated as the project gets structured, gets studied, gets elaborated. I have a Menti now again for you guys, so please return to that and let's see, because these questions are always interesting ones. 2 questions here for you in the Menti, and those are what percentage of investment decisions are typically based on spreadsheets? And then the other question is, which will come after that, what percentage of spreadsheets have errors in them? So I will also share my screen over to the Mentimeter.
So Koen, is this more of do you have an answer for this? Or is this also from your side kind of an estimate? Or
I have an approximate answer to this. I have to say these are questions that we have been using in financial modeling trainings for quite some time. So I would have to go back and find the source. But they're making a point of that. They're making a point of it. So the percentage of investment decisions based on spreadsheets between 0 and 100, I see quite a nice little range of outcomes from the participants. The value that we derived from a source that escapes me now, but that we always refer to, is that roughly 80%, or for some reason the exact amount is 78% of investment decisions tend to be made based on spreadsheets. And of course, by almost always, since many years, those spreadsheets are Microsoft Excel based or a related platform, spreadsheet platform, very comparable platform. And that's interesting because it takes us to the next question. So please stay on your Menti for now, because the next question then asks, what percentage of spreadsheets have errors in them? 100%, says somebody. Wow. Nobody says 0. Very low confidence in spreadsheets. I'm seeing most of the answers coming in at the 50 to 100% bandwidth, with an extra one, I guess, at must be 75%, the extra high peak here. Thank you for that. So the answer that we normally give here is around 90% of spreadsheets have errors in them. And it's next to impossible to produce a spreadsheet that is almost entirely error-free. And so there is a whole routine and process around spreadsheets that professional financial modelers use, and that is being used in using financial models for structuring and then dispersing finance to minimize any such errors. But it does take you back to wonder, why such an important tool in making investment decisions is so enormously prone to errors, to spreadsheet errors. Makes you wonder. So 78% and 88%. Oh, come again. The nicest example, very briefly, is, and it doesn't only happen to a financial modeler sitting in an office somewhere, is a spreadsheet error that was produced by some of the smartest people in financial and economic academics, Reinhardt and Rogoff at Harvard University, who produced a spreadsheet error that was just basically comprised of simple formula errors, but what was found out only later. And in the meantime, different policymakers. For example, in the UK, I think it was used to justify budget cuts because of the economic argument and analysis that followed from the spreadsheet. So it happens to the best. And for some reason, we keep using spreadsheets and financial models. And maybe it's inertia, it's sort of, you're stuck in, you're locked in, so you can't do anything else. It's also that when you work with different parties across the value chain in setting up, structuring, and dispersing financing, everybody uses it. So you need yours, because of the network effect, you're sort of locked in. And maybe therefore every analysis done in an Excel file is maximally accessible and quite flexible for others to use and pick up. But as we said, and so prone to errors. And so the solution that most financial modelers and most parties in the industry take to deal with that is that a financial model needs to be built according to a very common, clearly agreed on standard that sets requirements for the form, the syntax, the sort of grammar, and the language of the financial model, so that when models and analyses are handed over from one party to the next party receiving the financial model would look at it and immediately recognize what's going on and what's happening, and would recognize also that the model is built in a way that makes it robust and makes it quite resilient against the risk of errors and unexpected flaws in logic. So this is something that's, there are multiple such standards. I've worked all my professional life with one of them. They're still not the panacea or the golden bullet to solving spreadsheet problems, but they are the best we have to make sure that our spreadsheets are reliable and robust. And they need to be, because they are about de-risking finance by looking at the future, by forecasting financial performance. And so it allows you, for a project or a company, to translate and test financial projections, to inform the financing process, the fundraising process, to avoid any misrepresentation in memorandums, in business plans, in investment pitches. So what you're telling people should also be backed up by the numbers from the projections, to reconcile and to bring together the developers and the investors taking more risk and the financiers being averse to taking risk. And to inform and to help clear all the hurdles in negotiating finally the financing agreements. So financial models are really great for that. They're not good for your sort of run-of-the-mill large company or large project accounting or management account preparation. So it's always sort of set aside from that and said that we have to underline you use professional accounting software for that, and you typically don't use a project finance model for that. Skipping through it a little bit, the development, the use of a financial model confirms the financial feasibility of business plans. It helps you, again, in the negotiations and clearing the final hurdles of negotiating financing terms. Needs to talk and dovetail with the business plan, and for companies detail the financial situation of the company if there's already a company established, and if this is your third or second round venture capital financing, it's a different type of model from when you're starting a new greenfield legal entity or financing. And for projects, it needs to allow the structuring of capital and conditions provided by not one but multiple financiers. So it's really supposed to allow for some complexity and for some more complicated structure. Good models are structured into at least 3 different types of worksheets, I would say. The input worksheets that are hard-coded and that are containing all the hard numbers that are brought in from other sources, from energy model projections or transport model projections or operations planning. The inputs are the hard-coded numbers. Then the calculations that are only formula-based, that use inputs from elsewhere, but that do not themselves contain any hard-coded numbers, and the outputs that present the relevant metrics, results, financial accounts, return projections for investors, financiers, and reflecting the business and the future of the project or the company as such. Model durations, you typically see them done depending on the nature of the model and the nature of what you're trying to analyze, for between 15 and 30 years. They can be annual, they can be monthly, they can be quarterly, depending again on the level of detail required and what you're using. And they, at the very least, always produce as an output a profit and loss account representing the tax and accounting reality of the company, the legal entity, a balance sheet representing the assets and liabilities that are accruing on the balance sheet that the company owns and that the company owes. And the cash flows, the funding flows that flow into and out of the company for undertaking investments, for covering operating expenditure, for paying personnel, the revenues being earned from leasing out assets or receiving user charges or anything like that. And then a summary of key metrics related to the financing, related to the investment returns. And then sometimes and that's usually done in hard-coded form as an input as well, the model will need to have a historical actual value. So if the company, for example, is not a greenfield new legal entity, but has an historic going concern business, or this is not your third or second capital raising round, but your third capital raising round, there will be a balance sheet, there will be existing finances. And so that will need to be reflected as well. I will skip through for a moment the principles of financial modeling, which I like to talk about at length, but maybe a little bit too technical for this session. So before a financial model gets built, one always thinks very clearly about the structure and what's necessary given the nature of the business or the product that is the subject of this financial model. So between inputs, outputs, and calculations, there's always a clear thought process around which variables are related and linked, and which operations drivers or which business drivers or which market drivers feed into costs and revenues, and given the funding profile that results from these costs and revenues, what kind of financing is needed. And that allows you then to start to produce return metrics, cover ratios, return ratios, payback expectations, cash flow waterfalls, balance sheet, P&L. And in the end, that allows for a conversation with financiers and investors about the acceptability and the viability of the product or the business, about the appropriateness of the terms and conditions. And so really that becomes in that way a living document, but also a tool for the negotiation of financing terms and conditions. So this is the screenshot from a typical index page of a financial model. I think this one is used for a corporate finance solution rather than a very strict project finance solution, but it gives you a sense of very clearly across inputs and calculations and outputs, the sheets that are used to produce the various analysis and calculations. And with that, I'm just pausing for an initial Q&A, and that I have another mentee question, Joanna, and then we can have a final Q&A, and then I'm about wrapping up. So,
Okay.
Do you have any additional questions in the chat that you want addressed?
Yeah, there would be one question that we have received. So from Tin,
Great.
are there any sweet spots for e-mobility investment in countries with fossil fuel dominated grids? And yeah, I think this has not actually been discussed. So the person joined a bit late, so he's apologizing if this was discussed already, but anything you wanna or can?
Sure. So the obvious answer is that yes, there are a number of countries that are that have notoriously fossil fuel dominated grids, and that in and of itself doesn't really affect the financing of an e-mobility project or company. It might affect the price levels of grid energy, and so that makes it a little bit more difficult to pin down exactly. Depends a bit on the market and the energy sector, what that's like. The impact that it does have is, of course, it makes it more difficult to generate large emission reductions from electric mobility, because after all, if you're charging your bus or your EV or your 2 or 3 wheeler from your grid being dirty as it is, it's not going to make as much a difference as it would make in a country that has a large reserve of hydropower and therefore very clean grid energy. And so therefore, a kilometer operated in such a country by an electric vehicle hugely hugely reduces emission reductions compared to a vehicle in a country with a let's say dirty carbon-dominated grid. What one does see, and carbon credit methodologies do account for that, is the inclusion of off-grid PV solutions set up with the designated purpose of supporting the project. So that's one way around that. And there are, depending on the performance of vehicles, there are ways even, and we are seeing that now in some programs in countries where the grid is rather more carbon dominated. There are in some vehicle categories possibilities, depending on performance, but there are possibilities of making it even work at scale. But it's difficult. It's not when it concerns specifically carbon credit projects. Of course, having a very dirty carbon dominated grid makes it more difficult. However, you have to remember that still talking about carbon credits, this is result-based finance. So as a country undertakes greening its grid across a number of years because of the installation of large-scale commercial PV that delivers energy to the grid, the benefit and the increasing impact of that cleaning up that sort of increasing the share of renewables in the grid will also translate into additional impact of the carbon emission and thereby the carbon credit revenue realized year after year. So that's the benefit of result-based finance. You're not stuck with the situation today.
Thanks. There is one more question that came in. Let's try to be quick on this one, and I think it's the last one we managed to take, at least for now. So could you give some real examples of mechanisms in the financial model on how to deal with periodic new investments? For example, replacement of batteries or buses versus volatile demand. Okay, it's a bit of a complex question to answer quickly, perhaps, but...
Yeah, it's not complex in the sense that if you're working with or if you are a good financial modeler, you're able to address this relatively technical question. What you model in is simply the investment linked to battery replacement as a flexible investment at different potential points in time, depending on your expectation of how the battery would deteriorate, the state of health would deteriorate over time, and that allows you to test that against the revenue you have and whether you're still able to meet your financing requirements, so your debt covenants, your cover ratios, and so on, and that allows you to have a conversation with your financier about that, but also with your OEM, because of course we do see that increasingly OEMs can produce high grade, really great performance, really good expectations from batteries, and are able to extend warranties on those as well. So that all kind of goes into some of that gets modeled quantitatively into a financial model, and some of that goes into contractual documentation. But they should both be on the table while you're structuring this. That's the long form of the answer. The short form of the answer is yes, of course it is possible. Yeah.
Should we move to the final part of the session?
Sure. I have a final applied example, which is a little bit drawn from practice, but I've generalized it a little bit. It's I think a venture capital example where somebody is setting up an OEM or a manufacturer of electric vehicles of some form or the other. And just to illustrate a little bit what we would do as we're testing a financial model and we're structuring a project, the questions asked are, for example, what is the impact of raising debt on the business? What happens to key financial metrics when operations change? And we're going to look, because this is about financing, we're going to look especially at the first sample question, what is the impact of raising debt on the business? So if you look here, what you see is a case of a project that is initially, or let's say a company, sorry, that's initially 100% equity funded. This is represented in the funding contribution graph, as well as the cash flow available debt service and debt service profile. And it's especially seen, and hang on to that number, in the equity return numbers, where the return is somewhere around 5%, depending on whether you are looking at the ordinary equity return projection or whether you're looking at the new investors stepping into the company. But let's hold on to the rough sort of 5% return rate projection coming out of the financial model. Now the question is, this is showing the situation for 100% equity investment, right? So that's the people who are coming in to invest here are equity investors who are very happy to take risk. They will not ask you to remortgage your house. They will not ask you to sell your dog or anything else of value and collateralize it. They will require quite let's say high returns. And now the question is, what happens if we change that situation? And we can very easily do that in a financial model, and we change the finance structure from 100% equity to only 30% equity, with the remaining 70% of the capital insertion being done from debt. Remember, debt being the extended by banks and others who are very happy to earn a lower return on what they put in because they also don't like to take that many risks. So they are going to ask you to remortgage your house and to collateralize the assets and to provide any and every security that you can provide them. And then the question is, what would the expected return to equity be, to equity investors be, in the case of this new situation where 70% of the financing comes from debt sources? So we're talking about 5% roughly, so 4.5 to 6%, but as a mean point, roughly 5% return in the top situation. What would be the expected rate of return in the second case? And I'm going to go and skip over to that question in the Mentimeter. And if you go to your own Mentimeter screen, you will also see the question being asked there. What would the expected return to equity investors be? And I will also share the Mentimeter instead. No, not this one, this one. So we have this question on your screen in the Mentimeter right now. What would be down or up from 5%? What would the expected return to the equity investors be if we change this 100% equity into only 30% equity and therefore 70% debt? Tricky one, because I see I'm observing a very slow rate of response. So either people are quickly building a financial model for us now, or still thinking through.
I think this might require some thinking as well at this stage. We can't see the exact numbers, right? But there's at least a range between,
yeah, it's a bit of
the
shortcoming of the tool, that I can't hover over it or anything and exactly see what people are inserting. So between 0 and 100, it becomes a little bit difficult to pinpoint the expectation. But there's quite some variation in the responses given, and I have to compliment everybody for still being sharp enough after an hour and a half to answer this question. So you've definitely earned your coffee after this session is over. Thank you so much. Yeah. All right. Without further ado, I think I will proceed to disclose the answer, and that was in the case of this particular financial model, 17%. So that still sits quite low in the sort of range of answers that are being given here, but it does represent a more material change maybe than it would seem to be from that difference. It's just because if we go back to the slideshow, what you have to imagine is that from an equity investor having to put in 100% of the money, all the money, and earning a return of roughly 5% on that. Now our financial model has shown that the equity investor only has to put in 30% of the money, but on that money, on that 30% of the total investment sum, he's not earning 5% anymore. He's earning roughly 17%. And so the impact of taking out very expensive investment money and putting in cheaper investment money is that the residual return, the remaining profit, the remaining return to the equity investor, the investor taking more risk, is improved. And so this is the very simple effect in the most basic form of leverage. If we put in more debt, if we leverage the product more, that's the word we use. But if we put in more low cost, low risk debt, and we're able to convince banks to provide us with that debt, it increases the return to the investors in the project, taking the risk, managing the project often. And that's one of the key discussions you will always be having in structuring the project, structuring financing, agreeing on terms and conditions, and the financial model is yeah, it's absolutely key in informing that discussion. And I think with that, and as soon as my PowerPoint slideshow returns back to life, I have something about the process here, but I realize that we're now running really tightly up against the time. So just I think this presentation will probably be shown around, just to share with everybody that yes, this is the modeling process is complex. It does require a meticulous step-by-step process. And this is what you do in order to also ensure the model is useful. It is maximally tested, validated, and reviewed against potential modeling errors, and there are even software tools to do that. So make sure that you undertake it with good preparation and with good planning. Begin with the end in mind. What do you want to analyze? What do you want to get at? What does the model need to show or materialize? Even start with a write-up. Just do work from the business plan forward. And maybe very important, especially if large sums of money are at stake, get specialist support in order to produce projections and to help you to an investor-grade financial model. And with that, I'm happy to take any other questions and discussions. And I'm again very pleased and honored to have had the opportunity to be in this training session with everybody today.
Perfect. Thank you so much, Koen. We also want to thank you for this really insightful and informative presentation. I think there was a lot of information, really useful, but also in a way that was quite easy to understand. So thanks for sharing all of this and preparing the presentation in such a nice way. Actually, I think we don't have any questions at the moment. I think we've also exhausted everyone perhaps with the long session, but I think it was still worth going through most of the material we had. And as said, we will be sharing a recording as well as the materials. The PowerPoint will also be shared with registered participants. So all of you will have that. Let me see. I think we're not getting any further questions at the moment, it seems. So I think we can start wrapping up then instead. So thanks to you, Koen. As mentioned already, it was a pleasure having you here again. And thank you everyone for joining the call, for listening in, for your active participation throughout the mentees. I think the responses were really interesting that we got in. Good discussions through that, and also very good questions. So thanks for sharing all of those. And I've included in the chat links, registration links to our next workshops taking place next week. I hope to see you there. And yeah, I wish everyone a very good rest of the week. And yeah, thank you again. And thanks, Koen.
Thank you, Joanna. Thank you all.
Thank you.
Thank you.